Investors sometimes like to buy stocks that are priced at a low market price. And that could be for a number of reasons. For one, maybe you like to own over 100 shares or 100 shares precisely so that you can trade options like covered calls, etc. Or maybe you're using a brokerage that doesn't allow you to buy fractional shares. So you're looking at stocks that are selling at market prices that are on the lower side. And so in this video, I'm going to highlight three undervalued growth stocks you can buy that are selling at market prices of less than $50 per share. That way, it fits in your budget if you're interested in owning more shares or if you're interested in owning whole shares and not fractional shares. I'll share with you my proprietary discounted cash flow valuations for each of these three, and I'll share with you other valuations that demonstrate why I feel these companies are undervalued. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So the first undervalued growth stock selling at a market price of less than $50 I will highlight and recommend is Fiverr, the gig economy platform. Its current market price is $33.76, and my proprietary discounted cash flow valuation model calculated this stock is worth $38 today. Now, that's even after I've applied a relatively high weighted average cost of capital to this company at over 12%. And this incorporates the risk in the business. One of the bigger risks it's facing right now is the rising effectiveness of artificial intelligence, where much of the revenue would have gone to service providers on this platform. People and enterprises could be using artificial intelligence instead of going to the Fiverr platform to hire people for these services. However, the Fiverr management team has noted that it's not having a net negative effect on the business. In fact, it's actually having a net positive effect on the business as the service providers on the platform are incorporating AI into their services and therefore getting more work because they're using AI and becoming more productive. And that's been my thesis on what I expect this business to become longer term. It also adds convenience. Many workers enjoyed the fact that they can work on the Fiverr and other gig economy platforms instead of being stuck with an employer full time. They can go on there and contract for services, work as much or as little as they want. And so I like this platform business model, and the valuation looks attractive to me, and you can get it at a market price of less than $50 a share. The next undervalued stock I'm going to recommend that's selling at a market price of less than $50 is SoFi, the online financial services platform. It's trading at a market price of $13 per share. And I calculated the intrinsic value per share for this business at $20. And that's even after I applied a weighted average cost of capital of over 14% for this business to incorporate the risks and the present value of the discounted future free cash flow. One of the bigger risks SoFi faces right now is that it has a portfolio of personal loans over $20 billion. And the US economy is noticeably slowing down ever since the president implemented tariffs on the trading partners of the United States. And if there should be a major economic slowdown, which I don't see happening just yet, I just think there's a slowdown, not a major slowdown. And if there should be a major slowdown and people start to lose their jobs, then those personal loans, SoFi will start to see larger percentages default. And that's going to cost the company hugely on the bottom line. So my weighted average cost of capital accounts for that risk. And even after that, I still see this business as being undervalued and an interesting option for investors that are looking for stocks that are trading at less than $50 per share. The third company I'm going to recommend at less than $50 per share is DraftKings, the online gaming provider. You can go to DraftKings and bet on the outcomes of sporting events. You can also play daily fantasy sports. You can also play games like blackjack and others depending on what state you're in, what jurisdiction you're in. The current market price is $35 a share. I calculated the intrinsic value per share of this business at $54.26, even after I'm applying a weighted average cost of capital of over 15% for this company to account for the greater riskiness. Anytime you're dealing with a gaming company, it comes with a larger degree of risk because of the relationship with regulators. The company needs to get the approval of regulators constantly, and regulators, depending on the mood they're in or depending on the party that's in power, can ask for greater uh, give backs in exchange for the opportunity to operate in the states. Some states have asked DraftKings for a much larger percentage of share of tax revenue for the company's privilege to operate within that state. And that's an ever changing situation. But thankfully for DraftKings, it's in a situation where politicians benefit from its existence because they help generate more tax revenue within the jurisdiction, and that's more money for politicians to spend, and politicians love to spend money. And so that's why I expect DraftKings to continuously gain approval in many of the states in the United States. Not every state, right? I don't expect DraftKings to ever be available in a state like Utah, and I don't expect DraftKings to ever be available even in a state like California, which I'm from, because of the embedded gaming interests in California work hard to keep DraftKings and other online gaming companies out, and they work collectively together to keep out new players like DraftKings. But even without those markets, DraftKings can be a very lucrative business for investors, and the current market price is less than $50 a share. Intrinsic value at over $54 a share. So I shared with you valuation using my proprietary discounted cash flow model. I also like to use the forward price to earnings ratio, and I like to go to finchat.io for all of my chart needs and all of my for most of my research needs for the companies that I'm following. And there's a link in the description for a discount if you're interested in these services. But looking at the forward price to earnings ratios, Fiverr looks incredibly cheap at a forward PE of 13. SoFi looks cheap at a forward PE of 40. DraftKings looks fairly valued at a forward PE of 54.5. So comprehensively, valuation looks attractive for these three companies. Looking at the combination of valuation factors, including the forward price to earnings and my discounted cash flow calculations. Of course, I talked about some of the risks in these companies, and you cannot ignore risks when you're making investments. Do your due diligence before making any decisions on any of these growth stocks to buy. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.